From New York City, for our viewers worldwide, I'm Manus Cranny, in for Jonathan Farrow. So you've had your hot jobs report, yields spike, stocks drop. The countdown to the market open starts now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, U.S. payrolls come in hot, hot, hot. And with the next inflation print just around the corner, traders continue to pare their rate cut expectations. We begin with the big issue, Jobs Day in the USA.
We have payrolls, December payrolls.
The first big test of the market.
There is a hissing sound in the labor market.
On whole, the labor market has held up pretty resiliently.
We're not too concerned about labor market strength.
I don't think that the labor market is going to reignite.
The course we're on is where hiring will slow and slow and slow, and the unemployment rate will gradually tick up.
Continued slowdown in payroll gains, but hopefully not too drastic.
Labor market holding in well, maybe easing, but easing very slowly and gradually. And frankly, that's what the Fed wants.
The market stays dependent, the Fed stays dependent.
When you look at where the Fed is right now, there really isn't that consensus for a March rate cut.
There has to be some sort of data reality check for the market.
I do think that the bigger risk is the inflation.
Next week's CPI number could be very influential in that market pricing on rates.
We're looking for data that ratifies that view that we're getting a soft landing.
The jobs market will play an important role this year.
Bloomberg's McKee joins us now with the breakdown on the latest report. So, Mike, there's no sign of a hissing in this economy. The force is strong. The jobs report looks robust on first take. Good day.
Yeah, the air is not coming out of the balloon, at least not yet, for the labor market. 216,000 jobs added. How strong is that? Well, you got to subtract the 71,000 revisions to October and November. So it may not be quite as strong as it appears. But when you have an unemployment rate that sticks at 3.7%, that tells the Fed something. We did see that number not go up as forecast because there was a big drop in the labor force. So not necessarily the best reason for that, but it still keeps unemployment very low. Average hourly earnings are the story of the day, up by 4.1% on a year-over-year basis. The thought was that they would fall back. Most of the jobs created in the categories that we have seen them being created in over the last 6-8 months: healthcare and social assistance, government, leisure, and hospitality. Interestingly enough, couriers and messengers lost 32,000 jobs. Those are the people who are dropping off all of your holiday presents for Hanukkah and Christmas. So it's kind of unusual to see that number there. Employment services down 29,000. Now, some people are going to say that is a warning sign, because usually if they start to lose workers, then hiring is going to slow down. Let's go back just a second to the average hourly earnings number, up 0.4 on the month. The expectation was for 0.3. And what you have there basically is a very broad set of pay increases across many different industries. And the problem is that the Fed's got to look at that and say, is this going to cause anybody to start raising their prices because they need to cover that loss? So we'll see what happens with that. And as you can see there, what we've got is the markets thinking that the Fed may be cutting back on the number of rate cuts, but it's the timing that may change the most today, Manus.
Yeah, well, we're certainly seeing a shift higher. Mike, thank you very much. In 10-year government bond yields, 405 is where we trade at the moment. Let's take the conversation to a veteran of the jobs report. It is BlackRock's Rick Reeder. Rick, good to see you again. This is hot. This is better than Some Like It Hot, and that just closed on Saturday night in Broadway. So first take, what goes through my mind is this sets the bar much higher for an immediate rate cut in March. Good morning.
Good morning. Thank you very much. And a veteran sounds better than older. So I'd say a couple of things. But it's solid. I think what Mike McKee described it. It's a solid report. I mean, you break it down, and we talk about it on this show a bunch. If you look at the breakdown of this thing, you have a different economy than we're used to. You look at healthcare and education. That is a demographic, that is a changing service-oriented economy. That's just hard. We're going to have sticky job growth. The thing that I think, though, if you step back and look at it, it's trending down a little bit. It's a little softer. You look at things like temporary hiring coming down a little bit. You look at the JOLTS report we got this week, professional business services coming off a bit. So listen, I think you have to characterize this as solid report, as Mike said. Average hourly earnings, by the way, the month-on-month was 0.44. It's a pretty strong number, meaning there's demand for labor. I think the paradigm that you have to describe in terms of the economy, markets, certainly employment, is when people say, gosh, this is, we're going into recession, deep recession. It's just not evident in the data. The data is solid, and you got consumption buoyed by what is low unemployment rate, still good wages, and it's still a pretty good employment report. So again, slowing economy, and it's certainly illustrative in terms of this, but gosh, certainly not falling off the cliff anytime soon.
And here is the conundrum, as you say, it's different this time. There was another cross-asset allocator who I've known for many years. He said this to me in the IB. This is a unique cycle, and unless the Fed and others have recently made a dramatic change in where they see the long-term neutral rate, their modus operandi should be to cut and normalize and get us back to 3 to 3.5 over 18 to 24 months. That's just longer and perhaps not as low as the market wants. It is a unique cycle, isn't it? We've not lived through a post-pandemic. I mean, I've been around a while, but I've not even lived through a pandemic. But, it is unique.
So, I mean, I couldn't describe it any better than the way you just said. So actually go back. Let's put this in perspective. You go back and you look at GDP in 21, we ran 12 nominal GDP. Then we got 7 in 22. Then we slowed down in 23 to 5.5 to what are we, 5? We're going to be 5.5-ish. I think this year you're going to slow to 4. This is not a classic. We ran too hot. The economy was running at 12 out of 10, created inflation. Now I think we're getting back to a normalized economy. And I would say one thing that I would challenge about where the Fed is. Listen, I don't think the Fed's going in March. I've said that before. I think it's crazy. They can't move. I don't think they'll move that quickly. But I do think they'll get the long-term funds rate down. I do think it'll get closer to 2.5 to 3 over time. The question is, how long does it take to get there? Listen, I think part of why I think you can start owning interest rates. This backup is great. The market got way too ahead of the Fed. Now you're backing up to levels that are starting to make some sense again. I'd love to see them pull back even a bit more. And I think when you think about where we're ultimately going, I think we're ultimately going to 2.5 to 3. It's a question of when we get there. I think they'll start cutting in May, June, and then I think they'll get there. With the 18 months, I wouldn't argue with that, but I think to a slightly lower trajectory, consistent with potential growth being lower over the next couple of years.
So I like your narrative, which is follow us, jump in. And what you say is, look, I can have a bigger splash if I jump off a higher diving board. We've had a small retracement is how I would categorize it, 10, 12 bips. How much more of a backup in yields do you expect? And where is perhaps a better re-entry point on treasuries, first of all? We'll come to credit very quickly.
That's a great question. So I think, by the way, we've made a good move out in the belly of the curve, out to the 10-year point. I don't think we're that far away. Would you be really excited if you got another 15, 20 basis points? I think so. Could you add a little bit here? I think so. The front end of the yield curve, I still think is too high. I still think we got to price more out of the Fed moving in March. I think we have to price a bit more out of how many cuts the markets are anticipating for this year. But I think in that belly of the curve, you're getting, would you start to put some money to work here? Yeah, I think you can put a little bit of money to work here.
Okay, on credit, I've had lots of opinions. It's priced to perfection. IG over high yield is where people want to be. Given this trajectory that we're on at the moment, perhaps delayed rate cuts, a quasi-soft landing, what does that do to credit? Do you want to see a little bit? I mean, $250 million was wiped off credit this week alone in 2 days. So we've taken a chunk out of credit. Do you expect it to back up further? Are there better re-entry points in credit?
So there's a lot of supply that's going to get, by the way, U.S., Europe, we're pricing a lot of supply in the market. Market needs to digest that. You push back a little bit. I think if you step back, these spread levels sexy, not really. But I think people are what they're going to realize for 2024. If we can create a portfolio using credit, using mortgages, using some securitized assets, if you can create a yield of 6 to 6.5 using the risk-free rate, some credit, some securitized, some mortgages, some high-quality assets, let's say you can build a portfolio of 6, 6.5. If the economy is moderating to 1.5 real GDP, 2.5 inflation, you can clip 6.5. That is really, in an environment, what's my return going to be in 24? If I can get a 6.5, maybe a little bit higher in fixed income, marry that to equities. So would I buy some credit? Yeah, I'd buy some credit through the indigestion of the supply that's coming, and just try and build this portfolio that gets you, gets you a 6.5 yield. That's pretty good in an environment with an economy that's slow and an inflation that's coming down, and a Fed that'll get to that long-term funds target. Boy, if you can clip 6.5, pretty good.
I'm on my way. I'm coming out of those things that they've told me now what CDs are in this country. I'm on my way. I'm looking for the Rick Reader, the retail fund, a little touch of that. Let's just close it off. I mean, give me your opinion. I was surprised. You say we have 17 trillion in cash assets across the market in money market funds. Now, to a certain extent, you're going to speak your own book, aren't you, Rick? In that it's going to be the bond market that picks up that. But is it that those yields, the structure of those yields you've just outlined to me, is a better return relative to the risk in equity?
So this is not the most profound answer you're ever going to get. I think that some of that money will come in equities. I actually think the technicals in the equity market, I think, are terrific. We're getting huge amounts of treasury supply. We're getting some credit supply coming in fixed income. I still think there's some equities that make a bunch of sense. I've been buying some in the last few days. There's some equities you could buy that trade at 3 times cash flow, 7 to 10 times earnings. That you look at energy, you look at autos, you look at airlines, you can look at casinos. There's some equities to buy. We could talk a lot about the Magnificent Seven. I think equities will get some of that money, and so my answer would be I think money will continue to flow into fixed income, and you're seeing that at the beginning of this year. You saw a lot of the quote unquote January effect happen in November and December. But I think you're going to see that money come in. But I also think people underestimate. You have big equity buybacks. You don't have a lot of IPO calendar in equities, and I think it'll support the equity market. My net conclusion is if I can get 6 to 7 in fixed income, I think equities aren't going to have the returns I had last year. But if companies can throw off in an economy like this 10%, 8 to 12% ROE, then boy, I'd take some equities too, and so build a balanced portfolio that I think will work this in 2024. Not spectacular equity-like returns in tech, AI, but pretty good numbers.
Hey, what's not to love about 6.5%? Rick, thank you very much, Rick Reader, there with the very latest response to this non-farm payrolls. Joining me now on set to look at the stocks ahead of that opening in bed, it is Katie Greifeld. Katie, how are you?
I'm pretty good, Manus. Let's talk about Tesla because it's slightly lower pre-market. That's after recalling 1.6 million cars in China. That amounts to virtually every car it's sold in the country. That recall due to issue with its autopilot system that increases the risk of crashes. You can see shares down slightly. Let's talk about Apple, too, because that bad week isn't getting any better. Of course, we had downgrades from Barclays and Piper Sandler dealing a 1-2 punch this week. Still sinking pre-market just a little bit, but still on track for its worst week since September. And really quickly, let's talk about NVIDIA. No real news here other than it's getting its mojo back. It had a rocky start to 2024. It put together a gain yesterday. It's doing the same today, Manus.
Okay, let's see how the cash opens a little bit later on. Katie, thank you very much. Coming up on the show, Republicans taking shots at Bidenomics.
The way we get the economy back on track is to first acknowledge that there is a spending problem in D.C. And it's not a Republican problem or a Democrat problem. Both of them did that to us.
The economy and politics, the conversation. That's next with iCapital's Anastasia Amoroso and PGIM's Michael Collins.
We need to get interest rates down. The reason why we have high interest rates is because government has borrowed, printed, and spent ungodly sums of money starting in March of 2020. Both parties are responsible for it, and that has driven the interest rates up.
The way we get the economy back on track is to first acknowledge that there is a spending problem in D.C. And it's not a Republican problem or a Democrat problem. Both of them did that to us.
The GOP presidential candidates there, Ron DeSantis, Nikki Haley, weighing in on the U.S. economy in the CNN town halls. Now, both facing off in Iowa in a debate next week as they compete for the GOP nomination against the frontrunner, Donald Trump. Trump once again declining counter-programming with Fox Town Hall for his own narrative. Now, this is the latest payrolls report coming in hotter than expected, giving President Biden a boost in theory as he's set to speak on the campaign trail near Philadelphia today, Haley's home state of South Carolina, on Monday. The jobs report, 216,000. The estimate was for 173. Kaylee Lyons joins us now. Will this give Biden a trump card? I couldn't resist the pun.
Well, Manus, you were exactly right in saying it should help him in theory, because, yes, the president is very likely to flex this data. He likes to tout how many months in a row the unemployment rate has remained below 4%. This month makes 23. The fact that wages are now outpacing inflation and that the unemployment rate and job creation figures are just working for him, again, theoretically. When you look at the polls, though, his economic approval rating remains quite low. He has really struggled to get credit for it. And as he campaigns for re-election, that is a problem for him. And that is one of the reasons why, perhaps, you are seeing that former President Trump actually is leading him in many national polls. Of course, Trump is also leading by a long shot the Republican primary race, and that remains true as we are now just 10 days out from the first real state contest in that race. The Iowa caucuses are coming up next Monday. Trump holds a lead. He's above 50% in most polls there, while Nikki Haley and Ron DeSantis are roughly neck and neck in the high teens. So that is why they were trying to make their cases in that CNN town hall last night. It was really interesting, Manus, to see them not so much go after each other as they really have been for this entire campaign, but to more directly go after the frontrunner in Donald Trump. Nikki Haley was talking about how chaos follows him and the country won't be able to stand another 4 years of chaos. And Ron DeSantis actually went after him on specific policy, from the border to spending to even the issue of abortion. So clearly they are trying to cement their place as number two, as it is highly likely that Trump is going to win in Iowa. But of course, we're all waiting to see if a real contest can happen after that, Manus.
Yep, Kelly, I think you've summed it up, which is, which of the two of them can put their stake in the ground as a credible alternative against Trump on the ticket. Kelly, thank you very much. Kaylee Lyons getting ready to go on the campaign trail. Joining me now to discuss the markets and politics, it's iCapital's Anastasia Amoroso and PGIM's Michael Collins. Good to have you both with us. Here we are, a hot report, 216,000 jobs, wages are rising. This should, in theory, play well for Biden. Anastasia, he needs this because he's lagging in the polls. How does it play out? Good morning.
Well, good morning to you, Manus. I mean, obviously, it is positive news for the economy and therefore for the president that we got today. I mean, you're absolutely right. The jobs report was absolutely hotter across the board, whether you look at wages that were higher than expected, whether you look at the number of jobs created, and of course, the unemployment rate at 3.7%. So that's definitely good news for the administration, for the economy, I think for anybody in the jobs market. But from a market perspective, of course, we're concerned about what does this mean for the Fed. And I think the very initial interpretation is, well, that likely means that the Fed does not actually cut rates. But I think that's a premature conclusion because, Manus, there's a lot of other developments on the macro front that we got this week that, to me, actually suggest that there is a rebalancing happening in the labor market. For example, the job openings number has actually come down to 8.8 million from the peak of 12. We also got the ISM prices paid index that declined more than expected. So you put that together with the inflation print that we're likely to get next week at 3.8%, core CPI. I think that also shows you that inflation may actually be coming down. So you put two and two together, good for the administration. I actually think good for the Fed and rate cuts as well.
OK, so that's a slightly contrarian call in terms of good for the rate cuts. Mike, let's take it across to you. Look, you say this jobs market will slow down, and that will come. But this data is not helping your prognosis. I want to get a feel for how much this early innings of still strong job growth is going to play out in Washington and around the country. Is it just too early for wages to matter at the polls? Is it too early for job creation to really matter at the polls?
It's actually remarkable, Manus, that that Biden's approval ratings are so low when you actually have had a really strong economy, a super strong labor market, really strong financial markets, and still, not seeing any love from voters there. We'll see what plays out later this year. But you are, in fact, seeing a clear deceleration in the labor market. We were growing at over 400,000 jobs a month last year, or in 2022. In 2023, that got cut in half to just over 200,000, which is consistent with the number we just saw for December. And I would argue by the end of 2024, we're going to be running at a monthly rate of jobs growth of, closer to 100,000, which a lot of people would argue is kind of a neutral state, consistent with the demographic growth. So it is decelerating, right? It's in the numbers, but it hasn't fallen off a cliff. And our base case is that it doesn't, that you just have a natural deceleration in the economy. I mean, our economy grew, close to 2.5% in 2023. That's actually probably higher than our potential growth rate. So in 2024, growth is going to probably be in the mid ones. There's nothing wrong with that. That's actually not much lower than the average real growth rate for the last 6 years or so. So I think we're just getting back to a more normal pace of growth, which is a little bit slower. And that I think is fine for the Fed. It's fine for financial markets.
Look, we're coming off 10 years of zero rates, so we're all beginning to understand what it is to actually pay a mortgage at 5, 6, 7%. So it is about a unique environment that is migrating. Anastasia stays with us, along with Mike, Anastasia Amoroso, and Mike Collins. My guest this morning dissecting the jobs reports and where you want to place your bets. Coming up, we've got morning calls for you. It is Jobs Day in the USA. Technically 216,000. Is that hot for you? We can revisit that conversation. We'll keep it going with iCapital's Anastasia Amoroso and PGM's Michael Collins right here on Bloomberg. This is Countdown to the Open. I'm Manus Cranny in for Jonathan Farrow. We're actually coming off the lows on equities. The sentiment out there seems to be focused more on the wages. It's a strong consumer rather than the risk of less rate cuts. Let's get across to some of the morning calls now and the recommendations. First up, BTIG downgrading PayPal to neutral, saying the company faces too much uncertainty in 24. Up next, Wells Fargo upgrading Carnival to overweight, seeing upside growth surprises and improving fundamentals. Finally, Truist downgrading Zions Bancorp to hold, expecting muted loan growth, higher expenses. It's going to weigh in the results. Coming up on the show, it is the opening bell with more from iCapital's Anastasia Amoroso, PGM's Michael Collins. First take and reaction on asset allocation on Jobs Day in the USA. Counting down to the cash open, there's a nice break of trend. The consumer could remain strong because wages are rising. This is a break of trend in the SPOOs. NASDAQ also breaking its force. Have we reached the top? Rick Reader says that in these bond markets, it's actually looking like a nice entry point. So the consumer is strong. Let's see where the cash turns to. Green on your SPOOs, on your NASDAQ. As for the broadening and breadth on trade there, as you can see, up, well, there you go. Russell is just moving to flat at the moment. Euro dollar. Now, we've had 6 days of strength on the dollar. So it depends how you view this risk move. Could it be a bit of a turnaround? 10-year yields 4.04, just up 4 bips at the moment on 10-year government bond yields. We've just had BlackRock. You want to find a nice high diving board to jump off and go long, and this is an appropriate time to pick up bonds. Crude up by 2.125%. There's an inventory story there, a bit of a draw, but also geopolitics playing in to the crude oil market, up 2.25% as we go home for the weekend. One stock to watch. I don't have a Peloton, but the shares are extending their advance amid residual optimism over the partnership with, you got it, TikTok. Katie Greifeld, take it away.
Pelton shares riding high. The pun was right there, Manus, and that's certainly what we're seeing today because traders clearly excited about this deal with TikTok, which will create a co-branded hub, which of course will feature Pelton content that will include select live classes, instructor series, and celebrity collaborations, rather, hard word to say there. We know it's been a rocky road for Peloton. Remember 2020, best year ever, shares up over 400% that year alone. But it's really struggled post-pandemic as people ventured outside. They went back to the gym. They're trying to turn the ship around, though. In addition to this TikTok deal, remember that Pelton also partnered with Lululemon and sports organizations to really help boost revenue and boost engagement. CEO Barry McCarthy expects that will start to bear fruit in the second half of the fiscal year, which ends in June. So we'll see if that's the case, but shares currently up about almost 6%, and that's on top of yesterday's nearly 14% gain, Manus.
Okay, Katie, thank you very much. Let's turn our attention to the earnings slate. Constellation Brands succeeding Wall Street's expectations, or even exceeding Wall Street's expectations. They've got a beat on the profit. Despite the soft guidance, what does it mean? How did the market take the divergence? Simone, what have we got?
Yeah, Manus, the shares up so far this morning, despite a pretty muddled earnings picture here. Constellation, of course, is the maker of Corona, Modelo beer, also makes wines, including Robert Mondavi, Kim Crawford, and a handful of spirits. So these results were for the quarter ended November 30th. Earnings per share roughly came in line, but net sales slightly shy of what analysts were anticipating. They were up, though, on a year-on-year basis, but their outlook was pretty mixed. Be able to reiterate their comparable sales or comparable earnings per share forecast for the fiscal year, which ends in February. But the real strength here is all in the beer and not so much in the wine and spirits. You may remember Modelo became the best-selling U.S. beer after the Bud Light controversy last year, and shipment volume there was up 3.5%, slightly shy of what analysts anticipated. However, when you look at shipment volume of wine and spirits, down 11.6%. It was supposed to be down just over 1%. If you're bullish on this, according to Vital Knowledge, you say, well, 84% of the company's revenue was due to beer, and so that offsets any of the weakness in the other segments. But if you're bearish, you look at that and say that cannot be ignored, that wine and spirits segment. We're going to be listening for commentary around that on the call later this morning, Manus.
Yeah, certainly things are looking very frisky. You look at some of those big European brands, Pernod Ricard down 4%, Remy Cointreau all down 12%. This is on an anti-dumping probe, but no permutation into the U.S. stocks so far. Simone, thank you very much. Wrapping up the numbers there. Automakers, Tesla, recalling more than 1.5 million cars in China due to autopilot issues, increasing the risk of accidents. Ed Ludlow is in San Francisco. Look, it's never good when you've got a recall. The question is the gravity of it and the size. So contextualize that for me.
Yeah, the reality is that it is a recall in name only. The concern of China's regulator is that Tesla is not doing enough to draw the driver's attention to the rules of the road. And in using autopilot, the regulator is concerned that there will be misuse that could result in accidents. The solution is an over-the-air software update. It's not as if the regulator is forcing Tesla to take back physical possession of the cars. 1.6 million vehicles in China impacted, as you said. Those are for domestically or locally built Model 3 and Y from 2014 through to the end of last year, and also any imported Model S and X within the same time period. And it mirrors really closely what happened last month in the US, right, with NHTSA. That was, again, a recall in name only, where the solution was a software update. You can do it at the press of a button overnight very quickly if you're a Tesla owner. But the stock is under pressure. We're down for a sixth straight session, matching the run of declines that Tesla had in August. The stock's trading at its lowest level since November. It's on track for its biggest weekly decline since October of 2023. It is down for a third straight week. So, again, a recall in name only, but it seems to be pressuring the shares. We're down 0.6% in this Friday session. And it's part of a sort of news cycle that has seen Tesla under a bit of pressure of late.
Ed, thank you very much. Succinct wrap up there. Let's stick with the tech theme. Apple shares off their weakest start since 2019 as Foxconn adds growing iPhone concerns. Alex Semenova joins me now with a little bit more. It's been a tougher week for Apple between downgrades and various issues. So fill me in on the latest.
Definitely, Manus. So Apple probably finally starting to recover from its New Year hangover today. Shares moving slightly higher into the open. That's after it gave back some of its blockbuster 48% gain from last year to start 2024. Shares seem to be on the mend here after falling for 4 consecutive trading sessions. After earlier this week, at least 2 brokers downgraded the stock, citing weakening iPhone demand. This morning, Foxconn also said that it sees sales falling for the current period. Foxconn is Apple's foremost assembly partner for its iPhones, and as such, provides insight into demand for the iPhones and other personal tech items. Shares were down 5.5% this year. As of yesterday's close, that wiped out $160 billion from its market cap. That also sent the stock into oversold territory yesterday, and those losses came after downgrades from Barclays and Piper Sandler. They cited weakening iPhone demand and concerns over the macro environment in China. Apple's woes also come amid bigger concerns over the Magnificent Seven stocks that powered the market last year. Wall Street concern that those shares may lose some of their luster in 2024. Apple was already the least loved stock heading into 2024, with the lowest number of bullish recommendations from analysts. Manus.
Underloved, but not underowned. There you go. Alex, thank you very much with the very latest. Anastasia Amorosa and Micah Collins are my guests this morning. Okay, so here we are. We've got a couple of narratives. Bonds are off their pop. They had a bit of a pop and a spike. 10-year paper got up to 409.71. I'm sure out there somebody paid 410. So let's just start the conversation there. Is 410 attractive enough? First of all, for you, Anastasia, is it a high enough jumping off point for you, as Rick Reeder said at BlackRock? Is that diving board high enough to tempt you in?
I think it's getting into buying territory, Manus, on a 10-year. And I say that because when you look at some of the fair value estimates for the 10-year Treasury, really it's a function of a few things, which is growth, which is inflation expectations, and central bank policy. And what we really had a repricing of right now is not so much inflation or growth, but the central bank policy expectations. And that's what pushed the 10-year back to that 408 level. So now that we are kind of, once again coinciding with a fair value territory on a 10-year, it is tempting to be adding duration. Is it a screaming buy? No, probably not. But I think Rick's point is well taken, is as we do get these pops in yields, investors do want to buy those because keeping the eyes on the prize, so to speak, if we are going into an environment where the Fed is going to be cutting rates this year, then the 10-year Treasury yield should fall, the 2-year should fall, and really all sorts of fixed income should do well as a result of those yields falling. So I do think you want to buy those spikes in yields.
Give me a level on the dip in the 10s, and then I'm going to move to Mike. If you make a call, you make a price.
I mean, I think anywhere between 4.1, where we are today, to 4.4 is really an interesting buying territory. That's what I would go with.
Okay. Mike, let me take it across to you. Here's the debate that I'm having on the IB at the moment. Are you a coupon clipper on the T-bills, or are you a duration-hungry bond trader?
Yeah, I think in general, Manus, over the intermediate term, the next few years, investors are supposed to be looking for opportunities to add duration, right? I mean, there's so much empirical evidence going back to many different cycles. When the yield curve gets flat or inverted like it is today, you're actually supposed to move away from T-bills out and add duration. And sure enough, that actually did work in 2023. It's just that it didn't work until the last 2 months of the year. But we're actually betting that over the next few years that you're supposed to leg into duration. I mean, we did cut some duration on that huge rally into the end of the year. I think it was a little overdone in the near term. The Fed rate cuts that were priced in were too aggressive in the near term. Those are paring back a little bit. Mm-hmm. And similar to what Rick Reeder, I hate to be consensus, but similar to what Rick and Anastasia are saying, you're supposed to buy on the dips in rates. You get any backup kind of into the 4s, 4 to 4.5. I'll put a bigger range on it. Investors are supposed to be adding duration there.
Far be it from me. The reason why I left being a broker and left being an advisor is because, I'm the biggest contrarian trade in the world. So, consensus was a little bit off last year. There's nothing wrong with jumping in with consensus this year. We're having this great debate about breadth and dispersion, and this is the year that we're going to go for breadth. Is that part of your narrative, Mike? I mean, you look at the turnaround. The NASDAQ had a little bit of I would just say, a moment of realization. I call that healthy. So are you in for broadening the reach, or do you think I should stay at the top, stay with the 7, stay with the strong, the balance sheets, stay with the innovation?
I'm a deep value contrarian investor as well, Manus, and it can be painful, and we're typically contrarians, we're typically early, but I like the value story more broadly across the stock market, away from the big high flying tech stocks. I think the smaller caps, the value side is fair value, if not a little bit cheap. Obviously, you're seeing the Russell 2000, the small cap index, really trade in line with rates, right? If the markets are pricing lower rates, a more dovish Fed, that's really bullish because those companies tend to be more correlated with the high yield market. They tend to be a little more levered to the economy, a little more levered to interest rates. So I think an easing in financial conditions, lower rates as we go through the year, the Fed cutting rates will support those more undervalued parts of the market.
Now, of course, Anastasia, you make the point very, very clearly, which is tech alone is not, big tech alone is not going to save me. It's not going to make or break me either. But you do want to broaden the church, so to speak. I want Nancy Tangler this morning saying, look, you just want to buy Apple on the dip, stack it away, say 5 years later, this thing will throw off dividends. But for you, it is about owning more than just tech. So what do you want to own apart from big tech?
That's right. And first of all, I don't think big tech is a sell necessarily. I do think that if you do have cash to deploy in money markets, and as we know, there's 1.4 trillion that went into U.S. money markets last year. If you're looking for places to deploy that, I think there's a lot of them. So I do look like some of those value trades and some of those contrarian trades that didn't perform well last year. So there's a whole host of them. Some of them are value, some of them are growth that's still trading at a discount. So I do think if the central banks around the world, and the U.S. certainly cut rates, then that bodes well for leverage and lowering the cost of it. And that means that smaller companies can perform better. That means real estate companies can perform better. And so I would be looking for pockets of opportunity in places like real estate, and frankly, in just the equal weight index of the S&P 500, because there's a lot of companies there that will benefit as a result of lower cost of leverage. But on the same, by the same token, I also do want to have some growth that maybe didn't perform so well last year, and that's smaller cap growth. So think cybersecurity stocks, think all sorts of unprofitable technology positions that should benefit from better sentiment due to lower rates.
Okay, Anastasia and Mike, you're sticking around. We're not done with you yet. Coming up on the show, Investors Digest, the latest jobs report.
So the last couple of weeks, there's been a sort of change of view that the Fed rate cuts might materialize a little bit more slowly with less force. And I think that this just reinforces that.
Now we look ahead to next week's big inflation print. That conversation next on Bloomberg.
So the last couple of weeks, there's been a sort of change of view that the Fed rate cuts might materialize a little bit more slowly with less force. And I think that this just reinforces that. The economy is still doing pretty well. Looks like we're going to have growth in the fourth quarter of 2% plus. Financial conditions have eased a lot over the last couple of months. So I think that risks are that the Fed's going to keep rates higher for longer.
Strong payrolls number reports dimming the prospect that the Fed will lower interest rates anytime soon, specifically March. Now, 50-50 towing costs. Coming ahead of the big inflation print next week, the headline number is expected to edge higher. That's amid rising gasoline prices. For more, we've brought Bloomberg's McKee back into the studio. So you've had a little bit of time now to digest this. Strong numbers, strong wages, but you say this is a challenge to get everybody to meet in the middle. What do you mean by that, Mike?
Well, basically, we know the Fed and the markets are essentially married to each other, but they're not sleeping in the same bedroom these days. They're not even sleeping in the same house. They're neighborhoods apart in terms of what they think is going to happen to the Fed funds rate. You see the Fed, they're thinking about a median number of 3 rate cuts, and the market's still pricing in between 5 and 6 even after the jobs report today. So something's got to give at this point. And the question is, when does it give and how much? Next week, we get the CPI report you mentioned, and basically just because of base effects, it's the headline number is going to go up. So how do markets react to that? The Fed also has a PCE report before their next meeting, and fourth quarter employment costs, which could be affected by the average hourly earnings number that went up today to 4.1%. And then before they get to the March meeting, they've got 2 more payroll reports, 2 more CPI reports, another PCE report. and then the Fed meeting on March 20th. We went into this week thinking that the Fed was going to cut rates, or market did rather, thinking there was a 90% chance the Fed would be cutting in March. That's down to 60% now. And by the end of the year, we're down to just 5 cuts. It would be 6 if you get to January of next year. Now, here's a chart I want to point out to people, too, because this is a big part of the debate, is financial conditions have eased. But these financial condition indexes are basically reflecting what's happening in the markets, not necessarily what's actually happening in the credit world. As you can see, the price of money for cars and homes and the prime rate for businesses and credit card rates have barely gone down. So we're not seeing the kind of loosening in financial conditions that people are thinking we should be seeing because of the drop in the financial conditions indexes. So the Fed still has some tightness that they could take away if they want.
Okay, I mean, that's certainly one to reflect on, the difference between FCON and reality. Mike McKee with the very latest analysis of the jobs report. Anastasia Amoroso and Michael Collins are with me as guests this morning. I mean, there is a thought for us just to close off on, which is that long variable lag could yet arrive if you look at the differential between FCON, which is obviously very louche and it has eased considerably, versus reality in the economy. Mike, are you banking on that?
Yeah, I think it's really a tale of two economies here, right? The people who have assets to invest, the people who own houses, the people who have locked in low mortgage rates are really benefiting from the environment today. But a huge percentage of the population, Manus, in the U.S. and globally are subjected, as you pointed out, to those tightening financial conditions, and they do chip away over time. And I think that's one of the reasons our view is that you will see weakness in lower middle income consumers. You're seeing that already. You're seeing consumers trading down pretty significantly across a whole range of different industries. You'll continue to see that bite. You'll continue to see growth on the margin slowing down as a result of those higher interest rates.
Yeah, we're just coming out into a very unique new paradigm. Anastasia, I mean, we've been fairly bullish on good jobs report, wages rising, stocks are off their lows. You know, it's quite halcyon in many ways. But you warn that there are spoiler alerts out there, and one of those is the size of government debt. So is that, I mean, this was an obsession by the bond market before we went off for Christmas, wasn't it?
Yeah, it was. And Manus, that's one of the reasons why I was saying that this is probably not the last spike in yields that we see, because as we progress through the year, we have to deal with greater sizes of Treasury auctions. And we, of course, have the quarterly refunding announcement that's coming up at the end of the month. We're expecting the size of Treasury issuance to be up 22% this year as well. And there will be periods potentially of a market indigestion that could cause those spikes in yields. But once again, I think investors should be looking to buy those. And then the other thing that I worry about somewhat is that, you know, you do have the size of debt pile, whether it's the government, whether it's the commercial real estate, whether it's maybe pockets of private credit. They do have to shoulder the burden of higher rates, whether it's the floating rates or through refinancing the upcoming maturities. But when I take a step back and I look at the size of them and what levers they have to pull to deal with that, I think those risks are not systemic, and I think they are manageable.
Okay, manageable risks and things really not as bleak on the jobs front as we anticipated going into this. Anastasia, thank you very much. Anastasia Amoroso and Mike Collins on the markets. We've turned it around. We're in the green on the equities. The jobs built by 216,000, quite a bit ahead of the estimates at 175,000. S&P futures trade up 0.2%, and NASDAQ up 0.25%, bouncing from the lows. Coming up, the market moving events that you need to watch out for. That's next in our trading diary. what do you need to keep an eye on for the next week? This is your trading diary. This is what the agenda is. ISM Services coming in at the top of the hour. The Atlanta Fed President Raphael Bostic speaking next Monday. More Fed speak. New York Fed President John Williams on Wednesday. Plus, it's the deadline for the SEC to vote on the Bitcoin ETF applications Thursday. CPI, that will define the next bond move for you, along with the jobless claims. And we round out the week with big bank earnings kicking off. Statement from the President of the United States, Joe Biden, at the White House saying workers' wages and wealth is now higher than before the pandemic. Prices are coming down on gas, milk, toys and airfares. That's it from me for this week. This is Bloomberg.